Instead, what we got was clearly a divergence between gold and related and the rest of the world. Everything else is going down the swirling very rapidly. And I don't just mean in the US, we also monitor the blue chips of Europe.
We had to go live today because of what the markets are doing. It's pretty crazy out there. We're seeing the stock just tumble to new lows for the year. It's down around 16% for the Dow, for the stock market there. Now, I'd like to share this chart you gave me here, just to kind of give context what we've been seeing this year. So this is the major stock market indices, real estate, bonds, and gold. So gold is actually here is the only one that's up year to date, and all the other ones are down. Can you share with the viewers what we're seeing?
Just a tad more. Scroll. Yep. Yeah, there you go. Gold this is Friday now. Okay, so it's year to date, and there's a big point here. All of these asset categories you see on the graph are what you can call traditional or even tactical portfolio components that most large pension funds, not hedge funds, but general funds will focus on as their acceptable components, put it that way, okay? It's traditional. Gold is viewed as, it's traditional, it's always been there. Nobody likes to admit they use it, but sometimes they have to, okay? Normally in a given year, and this is we're now 6 months into this new year, the various sectors or components here will be moving in different directions sometimes. Like you might have stocks down and bonds up. So if you're an asset manager, got to remember this, 80% of the US stock market is managed by funds. Pension funds, private funds, et cetera, et cetera. Not little investors, but funds. Now, these guys manage by sets of rules. And these are their acceptable categories. The stock market, I've got two of the major indices here on the left. HYG is a high yield corporate debt ETF, so it reflects the corporate debt market. MUB is the muni bonds. XLRE is an ETF of real estates, reflective of other real estate ETFs, by the way. And TLT is reflective of long-term US government bonds. So as you can see, it's 6 months into the year, you're running a fund and you're desperate to find something that's up. Every week goes by, every month goes by, it just gets worse and worse. None of these guys is behaving well. And by the way, you can take each of these bars that you're looking at, and you could probably add about 2 to 3 more percent to the downside just today on what these look like. Gold, as of Friday, was up 2.4% on the year. No big deal, right? But when you're a portfolio right now, by the way, it's only up just a shade on the year, but it's up on the year. In distinct contrast to these other categories. So you as a fund manager are starting to get a little bit panicked here because every week goes by, month goes by, your environment gets darker and darker, and there are no places to run except gold. Now, at this point in time, it's obvious something's been happening here because 6 months into the game, and that market on the right there is still, now it's unchanged, but it's unchanged on the year, and everything else is down 15 to 20, some 30%. So you as a fund manager have to make a decision. Reality is forcing you to say, okay, I've got to have a place to hide. I don't even care if it goes up, just don't go down, okay? And they're faced with this reality. And as every month goes by, this reality smacks them in the face again. And so fund managers are like individual investors at some times. They can panic, just like herd-like mentality of speculators. You put them under enough pressure and they finally will all herd to the same gate. And we're arguing that already some of them have started to move into gold. We know because they've said so. I won't give you names, but there's some big funds out there that have already established some minor positions in gold. It doesn't take a lot to move that market, by the way, because it's fairly small, gold and related, gold miners, for example. But anyway, I think this is a reality that people need to focus on when they look at the day-to-day gold. And today, for example, they're all upset, and we're not real happy about it either, but gold's down hard. It's down less than the S&P and the NASDAQ for sure. So again, it's the spread differential is still preferring gold. But the reality is that the Fed has broken the inflation bubble. No, not commodity price inflation. That's a narrow definition. But the other categories that have been boosted by a dozen plus years of monetary expansion and effectively free money, QEs and so forth. And that would be the stock market in the US, especially NASDAQ 100 over the S&P, and all these other categories as well. In fact, the Fed has outright bought some of these ETFs in front of you, HYG, muni bonds. They've ceased buying them, but they bought them from mid-2020 through late 2021. So they were active owners of these debt instruments on their balance sheet. The question now is, now that they've pricked the bubble they didn't want to prick, namely the paper asset bubble that they created, they can get the blame for it. It's coming unwound, and it's coming unwound in a whirly type fashion. We called the top in January for the NASDAQ 100 and February for S&P. We said, that's it, it's over. Now the only issue is, what's the nature of the decline? And we thought it would be a layered process, which so far it's been, but it could pick up speed at this point, because today's action, assuming you close the month out anywhere around where you are now, you're going to blow out the last long-term annual momentum support that momentum structural analysis has predefined as being critical, at which point the full-fledged bear begins, to the point where everybody will then realize, oops, this is no longer buy the dip situation. This is where do I get out, or where do I go situation. And again, we continue to watch gold and related as to their ability to attract money that looks for a place to hide. Whether they like it or not, it's the only one of the acceptable categories that is not negative and is definitely outperforming all the other categories. So we think this could be a factor in what happens to gold going forward. Another factor would be when the Fed realizes that they have in fact broken the inflation bubble, but instead it's the paper asset inflation bubble that they created. And then they try to revert back to some approach that defends collapsing assets they can't allow to collapse, like municipal bonds, state bonds, high yield corporate debt defaults, et cetera, et cetera. At that point, they lose all credibility because of their flip-flops. And we suspect we're nearing the point now where these markets will cause the economic, quote, data points that the Fed is, quote, sensitive to suddenly shift from these boisterous, strongest employment numbers we've had in decades to something darker very rapidly. In which case their data points will flip just like these markets did into highly negative territory, in which case the public is going to realize, and some economists have already started to realize, they're breaking inflation, but it isn't the commodity side of the equation. It's these other markets that we can't afford to have broken, because there's certain real world in the street consequences that can flow from it. So we live in an interesting time.
We definitely do live in an interesting time. And I know the first time we had you on here, you were mentioning that there would come a time when really Wall Street woke up. And it seems like we're about to see that. And we might be seeing that right now, where the major hedge funds, the major funds out there, are people running them are probably freaking out right now as they're seeing the stock market on the verge of collapse. And you said that people would rush into gold, and there just won't be enough gold out there. There won't be enough room for everyone, and that we'll see a lightning fast move higher. Is that what you see really around the corner?
I still see it as a shock effect, and so far we're wrong. Okay, I thought it might have occurred earlier than this. Instead, what we got was clearly a divergence between gold and related and the rest of the world. Everything else is going down the swirling very rapidly. And I don't just mean in the US. We also monitor the blue chips of Europe, and they're in collapse mode as well, almost overlay of the NASDAQ 100 charts. So we have a global situation where we think the metrics now, the stupid delayed lag metrics that central banks like to look at, will suddenly go dark. At which point then they're confronted with the academic issue of, what are we here for? Now, I heard an economist on Bloomberg Radio the other day, and I forget his name, pardon, a Nobel Prize winning US economist, an academician. Okay. He essentially said what we've been saying for a while, which is what I just said, and that is the Fed has a real problem here. And that is that they need to be focused. This guy argued they need to be focused more on the consequences of what they're creating the economic consequences, the market consequences, rather than the commodity inflation. He says, oh, the commodity inflation will go away. Well, that's true. It always does. Okay. It might take another year or two. But he was already getting around to the major point that they need to be focused on the collapsing asset categories that will impact the real world. They need to revert to that primary role. And I argue that as soon as they start to get data points that they can hold up in the air and say, "Ooh, we've got to consider this," that you'll start to hear some sort of non-hawkish or less hawkish statement out of them. And that's about all it's going to take. Because at that point, I think asset managers in particular, who've already obviously been shifting over to gold to some extent, that's why you have that divergence we just saw in the performance, stark divergence. They're going to move more herd-like into gold again because they're going to realize that the Fed is scared of reality and is backing off in the least bit from their hawkish stance. Then what does that mean? They've got the only one alternative, and that's what they do: monetary expansion and balance sheet expansion. Even if they don't play with rates anymore, raise rates or lower them anymore, the balance sheet will speak, and they'll have to go in and buy assets again. And we argue at that point, then the asset managers will realize that, oh, they can't break the commodity inflation bubble. They've broken the other one. We've got to go where it's safe. And we know that their new policy, if they shift trajectory at the least bit, is going to benefit those things.
Now, just for our viewers joining right now, we're here with Michael Oliver of Momentum Structural Analysis. We just have a few more minutes left, but we're really wanting to have him on live today just to give an update on what is happening with the markets, because things are moving so fast. We're seeing the Dow down. It was at one point down almost 900 points today, hitting a new low for the year, down around 16% for the year here. This is the close on Friday. And this is a chart that Michael put together showing that all the stock indices here and the real estate bonds are all down, but gold is up for the year. Now, what I want to ask you, Michael, is what do you think is going to happen on Wednesday when the Fed makes their decision? It seems like with all this chaos in the markets, how is the Fed going to respond? I mean, it seems like people are looking for them to do a half-point rate hike, but is that what they're going to do? Responding to all this,
I don't think
this
they'll
chaos
deviate
in the market?
No, I don't think they'll deviate in this hike. All they've got to say at some point down the line, and it may not be tomorrow, that depends, if the S&P and NASDAQ collapse 10, 20 more percent in the next 2 days, then you may have a different response, but let's assume that's not going to happen. Then assume it's just going to be routine hawkish. They're going to raise it half a point. That was fully expected. Also, the next one is supposed to be a half point, fully expected. What I'd be looking for is the fresh economic data points that they like to refer to. If those start to shift dark, suddenly and surprisingly, actually not surprisingly, when you look at these charts, they insert some kind of word like we're data sensitive and we have to rethink our trajectory of rate rise. Any equivalence at all on their part could be rapidly interpreted to be they're scared. They're going to have to go back to their old policies, what they were born for, okay? Print money, support government bonds, et cetera. Once that perception is even inkled out of their phraseology of their meetings, I think gold could go ballistic. And I think, again, it's a herd-like thing. Remember, fund managers they get panicked too, especially when you put them into the corner that chart shows. They've got no choices. And each of those charts is now down another 2-3% from where it was Friday. So there's a point at which they have to panic and go where they have to go. They have no choice. Whether they like it or not, they're going to need gold and gold related or commodity related, but especially gold and gold related, I think. And I think that could happen with the subtlest statement from the Fed. Now, whether we get that on Wednesday, I don't know. But there's a point at which also market observers will realize what I've just said, and that is it's almost a necessity that if these markets keep collapsing, the Fed's going to have to change. Either that or they're going to walk away and just say, let it burn. And we know that's not what they're going to do. So it's an issue of when does the herd shift more and more toward that last category?